right, I want to welcome everyone back to this month's workshop. As some of you have been here before, you know we do a workshop every single month about different topics, about different things, all within the financial field. For those of you that this is your first time being at these workshops, I want to introduce myself, and we'll do that here in a second. But I want to talk about this week's topic or this month's topic. This is what is our risk tolerance? Risk tolerance is a key factor when it comes to picking your investments. So we're going to go over some misnomers about risk tolerances, how we choose what our risk tolerance is, all those things along the risk tolerance field. So again, for those who haven't been part of our workshop before, I'm Chris Price. I'm one of the certified financial planners here, and I spend most my day, if not all my day, reaching out and talking to the community and figuring out what's most important to us financially and uh, talking about that. So for today's meeting, we're going to talk about risk tolerance. We're going to talk what it is, why it matters, and how knowing yours can shape your entire investment decisions. So risk can have some negative correlations, but when it comes to investing, some risk can be good. In fact, it's impossible to avoid, and it's what actually creates opportunity and growth for our long-term financial plan. So if we look at our chart here, this is the S&P 500's annual returns from 1950 to 2024. Now, for those of you that are unfamiliar with the S&P 500, it's the 500 biggest stocks in the community. Now, the reason we use the S&P 500 as like a guide to the market is the theory is if the 500 biggest are doing well, so are the others. So that's why you see a lot of times we're working with the S&P 500, or when you turn on the news, they talk about the market as the S&P 500. So, cool. Now, let's look at this slide. This slide is going to have our risk versus return. This is something called volatility. And volatility may sound like a bad trait for investing. After all, wouldn't you rather know exactly what your investments will be worth tomorrow or next year? But there's an important trade-off with investments from our risk versus return. If we look at our chart here, we can see three basic boxes. We could also see a light blue line, a dark blue line, and a green line. And we could see how much they're moving up and down. Now, the up and down is actually what we call the volatility. So volatility is not just down, but it's up and down. We could see that from a conservative investor, we see more of a consistent line. From a moderate investor, we see more of that ups and downs. And obviously, from an aggressive investor, we see huge ups and downs. This is what we call volatility. Risk tolerance. Basically, what is risk tolerance? So, risk tolerance is how much volatility or price movement we're comfortable in our investments. So, a person with a higher risk tolerance is comfortable with more fluctuations in their market. Meanwhile, someone with a lower risk tolerance may experience a lack of sleep if their portfolio has losses or something of nature. So, understanding where you land on risk tolerance spectrum will help you build an investment strategy that can give you a greater chance of achieving all your financial goals without losing sleep at night. So, over the state of your portfolio, what factors affect your risk tolerance? We're going to go into details on each one. We're going to go into details about your experience with and knowledge of investing, your time horizon and how long you will have until you'll need to use the money you're investing, your total investable assets, and your personal comfort level with risk. So let's explore each item and how they relate to your risk tolerance in more detail. The first one, your experience with and knowledge of investing. Tolerance is something we can develop with experience. For example, when you first learned to drive, it was probably very scary to have all those other cars zooming around you. But as you continue to practice and gain experience behind the wheel, the other cars stop being so alarming. The same thing can happen when you invest. When you're just starting out, seeing how much your portfolio value changes from day to day, this could be alarming. But with time in the market, you may come to realize that these daily ebb and flows are just a natural part of the market cycle. Some days your investment values will drop, other days they will rise. And over a long term, the market has historically trended up. Once you understand more about how markets work, it becomes easier to tolerate some of the volatility. And by extension, your risk tolerance may grow as you're able to sleep better through things that may seem rocky at that moment. So, the more experience you have with investing and the more ups and downs you've seen, the more comfortable you may be and the more aggressive you may be able to take. But again, that's a personal preference. No. Next one, your time horizon. So in investing, we define time horizon as the length of time until you'll need your funds. So an investor who maybe is saving for retirement and is in their early 30s will have a longer time horizon, of 30 plus years. Meanwhile, someone who's maybe saving to buy a house, they may hope to purchase in 5 years, will have a shorter time horizon. How long you have until you want to sell your investments will be a key factor in how much risk you can afford to take. The more time you have before you need the funds, the greater your ability to take risk with your investments. This is because you'll have more time to recover if there's an investment loss and ride out any temporary lows in the market. Investors who are closer to when they are going to turn their investments into cash usually are more risk adverse. This is because they can't afford to have their portfolio drop in value right before they need to sell their investments. So your goals are what determines your time horizon. So long-term goals have long-term time horizons. Right? They can let you take on more risk with your investments. But if you have more than one goal, what does that mean for your risk tolerance? What should mean you have more than one risk tolerance. You can think of your savings falling into different buckets. You may have a long-term bucket for goals that are further in the future, such as retirement, or maybe if you have a toddler, their college education. Then you may have a midterm bucket for savings that are designed for near term, such as preteen education or a new car, something maybe in the next 5 or 10 years. And finally, you may have a short-term bucket for those savings that are more intimate, that are needed a lot closer in time frame, such as replacing an AC next summer or buying your teen their first car or something like that. Each of these buckets can have different time horizons. You might use riskier investments like stocks to save for investments that are 20 years from now, maybe that retirement goal that we talked about. But you may want to keep your AC fund that we talked about in a more consistent place where you know the value won't decline suddenly. Think of like a CD or something. So identify your goals. I want everyone that's on this call to look through these. Maybe there are some goals that you see here that you want to achieve, or maybe that are more important to you. So to determine your time horizon, you need to know what your financial goals are and when you plan to achieve them. But how exactly do you identify your financial goals? The place to start creating any financial strategy is with your values. What you value points to the goals that you're going to want to bring in. It's also going to provide you with what values or what goals give you the greatest sense of fulfillment. So your value should be at the foundation of any financial strategy. So, for example, if you value adventure, you may have a financial goal of saving for a trip to climb a mountain or something. If you value relationships, you may have a financial goal of helping support your parents in their later years. Someone who values maybe community may have a savings goal for charitable giving. This slide shows some examples of values that you may hold. Your values can change throughout your life, leading you to change or modify your financial goals. And this is perfectly fine. Nobody, or I'm sorry, nothing is ever set in stone. Your financial plan can be as dynamic as you are about your goals. Before we move on, I want to clarify something about financial goals. People often think financial goals as things they'd like to have, but goals can actually fall into different categories. You can have purchase goals, such as buying a new car or house. You can have goals to grow your assets for things you're saving for, such as vacation or kids' education. You can have goals to support your lifestyle, such as saving for home renovations or building a retirement nest egg. And finally, you could have financial goals to provide security, such as creating reliable income streams or a plan that helps you, let's say, age in place. The time frame for each of these goals can vary too. For example, a short-term purchase goal is for something you'd like to buy within the next 12 months. Meanwhile, a short-term growth goal is something maybe you want to purchase or use in the next 5 years. Many of these goals will be shaped by your personal values. If you value security, you may have more goals in the support and security category. Meanwhile, someone who values adventure may have more goals in the purchasing and growth category. Of course, you can and probably do have goals across all categories. The good news is there's no limit on how many financial goals you set for yourself. Another key factor when determining your risk tolerance is your total investable assets. How much you have to invest can impact how much risk you're willing to take on your investments. The more resources you have to lean on, the more you may be able to take additional risk. If you depend on your money if you depend on your money you invest to live on, you're likely a lower risk tolerance than someone whose day-to-day lifestyle won't be affected by the changes in their investment portfolio or the decrease in value from day or day. Another way of looking at this is your cash flow needs. You should adjust your risk tolerance to align with the amount of cash flow you need from a savings bucket. For example, you shouldn't invest money you need from your day-to-day expenses because you can risk losing value when you need to cover an expense on that day-to-day. But money you don't need for, let's say, a decade or more can benefit from a riskier investment to generate more growth. Remember, the second component of risk we discussed earlier, the risk of an investment not growing is in value, um, enough to change your goals. Sorry about that. The last one we have here, personal comfort with risk. Finally, your natural inclination towards risk plays a role in your investment risk tolerance. Some of us naturally are more comfortable with taking risks, and this can translate into how we choose to invest our money. So, a more cautious person type may prefer more predictable investments, and a risk taker may be more comfortable with the volatile ones. That said, this isn't always true. It's entirely possible that you're very cautious in general, but you're comfortable taking risk in your investments. For example, you may have a lot of experience investing and be confident in your understanding of how the market works. In that case, your investment knowledge may outweigh your natural cautious personality type, letting you adopt strategies that are more risky in your investments. So when you're thinking about your personal comfort level of risk, we want to focus on your comfort level with investment risk. How does that make you feel when you imagine your investments losing, let's say, 10%? And that may give you an indication of what your personal comfort is if you know what you would do if, God forbid, that was to happen. Why knowing your risk tolerance is important. Your risk tolerance is a key factor in determining the investments you use. Investors with higher risk tolerances can be more aggressive or use more aggressive strategies. But that doesn't mean more aggressive is always better. Taking on more risk than you can comfortably tolerate may cause you to make emotional decisions when the market gets choppy. It may also add uncertainty or unnecessary stress to your life if anxiety over your savings keeps you up at night. It's better to have an investment strategy you can stick to over the long term or the long run than to try to push yourself onto extra risk. It's also important to note that your risk tolerance can and will change throughout your life. As those long-term goals get nearer and nearer, you move them into the near-term to short-term savings buckets, and you may want to reduce your level of risk that you're taking on. So, now that we have an understanding of risk tolerance and why it's important, the next question is, what do we do with this information? Well, risk tolerance helps shape our portfolio decisions. You can use risk tolerance to guide the investments you choose. Since each investment has a different level of risk, you can combine different investments to create a portfolio with a risk level that matches your risk tolerance. This mix of investments you choose with different levels of risk and return is called your asset allocation. For some of you who were on a session we did, I think a few months ago, we talked all about asset allocation. Did a small session on risk before that, but we talked all about asset allocation. For a refresher, or for those that are first joining us this month, what is asset allocation? Your asset allocation is how you divide your savings amongst different investments. At the most basic level, this would be the portion of stocks to bonds to cash or cash-like investments that you have. We use that example because that's usually what kind of investments you have in like your retirement account or your 401k, your stocks, your equities, your bonds, your fixed income, or your cash. So for example, you might hear people say, or you might have 60% stocks, 35% bonds, and 5% cash. For every investor, or I'm sorry, every investor will have a unique asset allocation that's tailored to their situation, their goals, and their risk tolerance. Like your risk tolerance, your asset allocation can and likely should change throughout your life as your goals and as your risk tolerance change. You manage the risk in your portfolio by adjusting your asset allocation. This works because different investments carry different risk. For example, stocks are generally more volatile than bonds because they move more, right? And bonds are generally more volatile than cash. Therefore, a portfolio that has 80% stocks to 20% bonds is more volatile than a stock that has 50% stocks and 50% bonds. It's important to recognize that risk exists on a spectrum. Even when there's broad asset categories like stocks and bonds, there's different degrees of risks. For example, bonds can be investment grade, which would be less risk, or non-investment grade, also called high yield, which is a little bit more risk. Investment grade bonds are from issuers that are deemed less likely to default in their debt, means more likely to pay you the money they're going to pay you. Non-investment grade issuers are generally at a greater default risk and have to give you a little bit more because of that risk. But to compensate for that, like I was saying, to compensate for that, these bonds tend to be a little bit higher interest rates, right? Hence the term high yielding. You're taking on a little risk by investing in those companies. They're going to give you a little bit more return, subject they don't have any credit issues. So stocks also come in different types. Large cap stocks from bigger companies tend to be less risky than those from smaller companies. Right? That's because smaller firms are more likely to have revenue fluctuations and could more easily go out of business. Geographically, it can also play a role in your stock's risk level. Companies based in emerging economies like India or Mexico tend to be more volatile because of less stable economic and political situations. Meanwhile, a firm based in a developing nation like the US or Europe may be greater stability in general. So as you shape your asset allocation, you'll want to think on both a broad and granular level, right? The broad is the stocks, bonds, and cash. The granular level is as you can see on your screen, the in between sections there. Your risk level isn't only about how many stocks you hold relative to bonds, it's also the type of stocks and the type of bonds you own. as you could see in this chart, from conservative to aggressive in the different areas of maybe the same kind of investments and the risk levels that generally speaking they have. So how you combine investments in your asset allocation will determine the degree of risk. The more risky or volatile assets you hold versus the more stable options, the higher your level of risk will be. Let's look at a few examples of asset allocation and risk in practice. Remember, these are just examples. Risk and asset allocation exists on the spectrum, so there are many different types of portfolios and degrees of risk. Let's use a fictional character to illustrate a conservative investor type. We'll call her Cindy. Cindy is in her late 50s. She wants to retire in the next 5 years and has already started reducing her working hours. This has increased her need for predictable income from other sources. With her near-term goal, Cindy wants to minimize the ups and downs of her portfolio. Should She'd also like to generate some income from her investments. To do this, she decides she wants to use more stable investments that provide regular income streams, like bonds and CDs. Cindy's asset allocation might look like this pie chart shown here, right? With half of her savings in bonds, 30% in stocks, and 20% in cash equivalences like CDs. This would help reduce the volatility of her portfolio while providing some income from her bonds and CDs. Within each of these asset classes, Cindy chooses investments that can meet her dual objectives of stability and income. She uses investment-grade corporate bonds, considered by many credit rating agencies to be high quality because the risk of default is much lower, as well as treasury bonds issued and backed by the U.S. Department of Treasury. Notice that she has some stocks in her portfolio. This is to provide growth so her savings can keep up with inflation. As Cindy gets closer to retirement, she may even increase her allocation towards more bonds. This would further reduce the risk of her investments losing value when she needs to sell them off to fund her retirement. So, next example. Let's look at the opposite end of the spectrum. Now let's talk about Andy. Andy just turned 30. He's single and he's 2 years into his first job. He learned through his workplace benefits department how important it is to start investing early, and he determines that he wants to grow his wealth. He also determines the stock market can be volatile. So he isn't alarmed if he sees his portfolio value drop. He knows time is on his side. He's confident that he can ride out market storms. While his long-term goal and knowledge of investing, Andy has a high risk tolerance. So his comfort using aggressive asset allocation leans heavily on stocks. Andy's asset allocation may look something like this, with 80% of his investments in stocks, as we can see in this chart, and only 10% in bonds and 10% in cash equivalents. Since Andy's paycheck covers all his daily expenses, he doesn't need to keep any income from his investments. So he uses more growth-oriented investments. This includes growth stocks, which are expected to outperform market averages, value stocks that appear to be traded for less than what they're worth based on fundamentals, and high yield bonds that offer higher interest rates because they come with a higher risk to default. So even within the bond portfolio, Andy is taking on more risk than Cindy likely would. So now for the third example, Mary. This is our last example, and this is that middle of the road approach. We'll call her Moderate Mary. Mary is about to turn 45. Her son started college 2 years ago. She's been diligently saving in the 529 college saving plan, and she still has anxiety about the price of tuition. She also is saving for her own retirement. Mary has been through the same investment workshop that Annie did, so understand she needs investments that will grow to reach her retirement goal strategies. But she also wants to preserve some of her wealth she's built. So Mary chooses to use a moderate portfolio allocation like the one that you see here. With stocks and bonds part of her portfolio, Mary also uses more moderate investments. For example, she chooses large cap stocks, which are from large, more established publicly held companies in the US and international. She also includes more defensive stocks. Now, these are from sectors that, in most cases, perform better or lose worse during periods of economic declines. Remember, when I say defensive, or when we say defensive stocks, we don't mean defensive companies. We could, but not in this reference. We mean companies that kind of defend against market downturns. They include things like utilities, consumer staples, and healthcare, things that are going to need regardless of the time period we're in. And her bonds are less aggressive than Andy's, with an emphasis on investment grade corporate bonds and treasury bonds, rather than Andy's higher yield riskier debt. Now, as I mentioned earlier, risk and return tend to go hand in hand in investments. Here we can see this in action. Here we see the average annual return for each category over the past decade based on the data provided to MassMutual by market research firm called Morningstar Direct, which is just a huge rating agency. The average annual return for Morningstar's conservative asset allocation portfolio was 4.4% between 2023 and 2020. I'm sorry, 2003 to 2023. We could compare this to the average annual return for Morningstar's aggressive portfolio, which was more than double the conservative category, earning 9.44% from the same time period. And finally, the middle approach with the moderate asset allocation, earning 7.56% between those 2023 and 2003 to 2023. But returns are only half the story for investing. So I don't want you just jumping into the most aggressive because that last slide. Each asset allocation portfolios experience different levels of volatility and loss during that period. For example, the conservative portfolio, the best performing year was 2009, when the portfolio returned 19.26%. The worst performing year was 2008, when the portfolio saw losses of 16.22%. For the aggressive portfolio, the best performing year was 2023, when it made a whopping 30%, more than 10% higher than the conservative portfolio. But the worst performing year was 2008, that lost 38%. We can see the big difference, right? The conservative portfolio maybe made less, but it also lost less too. And the more aggressive one was on both sides of that. As expected, the moderate portfolio falls in between those two, with 24% upside and 28% downside. You may have noticed a common factor here. For both the conservative and the moderate portfolios, the best performing year over year, 2 decades came immediately after the worst performing year. This is actually a fairly common occurrence. I brought it up to highlight that the importance of staying invested, even during the hardest of times. If either conservative Cindy or moderate Mary had sold all their investments in 2008, they likely would have missed those returns in 2029. Can't tell you how many conversations I have about this and how many times you hear people say the same term. It's not about timing the market, it's about time in the market. As long as you have a solid plan, do not get emotional and sell because things are bad. If you have a solid plan, follow through with that plan and see what comes out on the other side, as you can see in these 2 examples. So we've covered a lot today. To recap some of the key points, remember that an important step in creating the right portfolio for you is determining your risk tolerance, or the size of fluctuations you can bear in your investments over time. Higher risk generally comes with higher potential return, but also higher volatility. There's no point in taking on more risk than you can tolerate if it leads you to abolish your plan on the first sight of trouble. The best investment strategy is the one that you could stick to. So Hopefully now you're armed with the knowledge that you need to understand risk tolerance and how it can shape your investments. We have created a free online tool that you can take to help determine your risk tolerance. It will guide you through a series of questions to identify where you fall on the risk tolerance spectrum. When it will provide, I'm sorry, then it will provide you guidance on how you might construct your portfolio around your risk tolerance. Remember, there's no right or wrong answers, only honest and dishonest. For the most accurate results, try to be as honest as you can. If you still have questions or concerns, either now or after the quiz, please don't hesitate to reach out to us. If anyone has any questions, you know you can always call, reach out. You could scan to schedule a quick meeting with us. I want to thank everyone for being part of this call. Risk tolerance is a huge subject, which has a lot of factors that go into it. So if some of you have questions on slides I might have went over too fast or slides you want me to talk about again, definitely reach out. We'll make sure that we address this with you. Well, I hope everyone has an amazing day. Again, scan the QR code and it will give you a direct feed to us, and we'll see you next month.